Hi friends, my name is Sushil and welcome to my YouTube channel Be Finovative. Today we're going to discuss about a new fund offer that has been announced by the Nippon Asset Management Company, which is the Nippon Asset Fund. Okay, so we'll review that particular NFO and we'll decide whether we should be opting for this NFO or not. Okay, so let's get started with our analysis. Okay, so this is the leaflet which has been released by the Nippon Asset Management Company, which was previously the Reliance Mutual Fund. Okay, so they have come up with a new fund offer, that is NFO, which will be opening from tomorrow. That is 7th of August, and will be open till 21st August 2020. Okay, so name of the fund is Nippon India Multi Asset Fund. Okay, which is an open-ended scheme, so you can opt for this particular fund even after the NFO gets closed. So they'll be investing in equity, debt, ETF, and commodity derivatives and gold ETFs. Okay, so that's why it's called multi-asset. It's not only equity; it's going to be in different assets. So this is being marked as a moderately high risk category because it involves equity, and that's why it's being marked as moderately high. Okay, so as usual, they have mentioned that their intention of this particular fund is to create long-term capital growth. Okay, and also to make sure that the fluctuation in the market is not impacting this particular fund by diversifying it with equity-related securities, debt, and money market instruments, and also commodities and gold ETF. Okay, so moving on to the previous history of how this particular different commodities, equities, and debt has performed over the years. Okay, so if you see in 2010, starting 2010, the gold provided 24 and equity was 17, debt were 4.7. Suppose it was only a debt fund, then they would have got only a returns of 4.7. But to think about the situation, we get a collaboration of these three, that is gold, equity, and debt. Then even if the debt is providing a less returns, it will be compensated by the high returns provided by the gold. Same is the case in 2011. Equity provided a very less of minus 24, right? But gold provided a maximum of 32. So it compensated, and you will ultimately you'll get a better returns, right? So that's a plus point. So that is why the fluctuation in the market or the economy, they don't want it to get impact in this particular fund. So they are going to diversify the fund by putting it into different economic instruments, okay, money making instruments. So so if you see the top performance for 5 years, it has been gold, for 3 years it has been equity, and for 2 years it has been debt. Okay, so but overall, if think of situation, if this particular fund has been invested in gold, equity, and debt, each year one of the instrument would have performed better. Okay, so ultimately they would have ended up with a very good returns. Okay, so that's a plus point of how this particular asset class works together. Okay, so diversification is a big plus point in this particular fund. Okay, moving on to the asset allocation. Okay, so the plus point of this particular fund is that it allows it allows us to put in different asset classes. For example, gold, equity, debt, and commodities. Okay, so that creates a very big portfolio diversification. Okay, and which will lead into the good optimal returns. So it's an open-ended fund, and as I said, like the allocation of how that particular fund is going to allocate their fund in different assets. So 50 to 80% it will be in the equity market, 10 to 20% it will be in the debt or the money making instruments, and 10 to 30% it will be in the commodities. So out of this 50 to 80, 50% is mandatory to be put in the Indian domestic market. Okay, so that's what they have mentioned here. Okay, so that will be around large cap will be around 40 to 60, mid cap will be around 40 to 60. Okay, and overseas market they have liberty to put till 30%. So out of the 30, the majority they'll be putting the money in the US market. Okay, so that's an international market exposure. Next one is the commodities, which is they're applicable around 50%. So they can put money in different metals or energy-related instruments or even gold. Okay, so that creates actually a very good diversification. And then comes the fixed income instrument, which again 15%. So it can be either a debt or any other instrument which provides a steady returns. Okay, so the risk is less, but it will get a steady returns. So that's about asset allocation, and the investment rationale is that funds seeks to provide a diversification across assets. That's what we mentioned, right? So they are putting in the different asset classes, and it provides a good diversification. Okay. So we'll get the benefit of tax by rebalancing within the fund. Okay, so they'll keep on changing. So okay, that's it. And so they have given a model portfolio, how this particular, based on the current data available, how the gold, equity, and debt had performed over the years. And based on a sample calculation, they have given a model portfolio here. So if you see this one, the black one is the portfolio they created. And altogether, if you see, by 2020, it has performed very well compared to the other things. Okay, compared to the other two. Gold is still on top, but overall, this particular model portfolio would have provided better returns. Okay, so that's what they want to depict here. That this is a sample chart calculation they have shown here. So that is one thing. Now, when checking about the historical returns for the similar funds that we have it. Okay, so we have the money control here, and if you see, these are the similar funds. Again, the multi-asset funds which is available in the market as of now. And if you see the historical returns, it is quite good actually when we see the 1 year chart or the 2 year chart. Okay. But over the years, it has been around average returns, I would say, around 6 to 7% returns has been provided by these funds. Okay. But I think in the COVID situation, since the gold prices has gone up, so the recently the returns has been very good. Okay. So this has been the historical returns of the existing asset, multi-asset funds in the market. Now the main question is whether we should be opting for this particular NFO or not. What I would say is that I think you should hold on to your thoughts about buying this particular NFO at this point of time. We should be actually looking into the portfolio they're going to create. See, currently they just mentioned about this is a certain percentage of asset allocation they're going to do in each of these particular assets. Okay, but let them come up with a portfolio. Okay, after the NFO is over, once it is released into the market, let them come up with a particular portfolio, and then we can assess the portfolio details, which companies they are holding, and how the diversification is being made, which are the international equities they are putting the money into. Those kind of details will get a better understanding once the portfolio is out. Okay, so it's my suggestion is that wait for this particular fund to get listed, and they come up with the portfolio. And after the portfolio has come, then accordingly you just check the portfolio if they have a very good holding across different equities or not, and then you take a decision whether you have to opt for this particular fund or not. I always say that NFO is actually a kind of a risk because it's a new fund. We don't know how it will perform, and that is a kind of a risk factor you have to take into consideration if you're going to take this particular NFO. Okay, and that's what I would say. And so my take is I'll wait for this particular fund to get listed in the market, check the portfolio, and then take a decision whether to buy this particular share, buy this particular mutual fund or not. Okay, I hope this particular video was helpful for you to understand this particular NFO by the Nippon Asset Management Company. And thank you so much, and please like, share, and subscribe to my channel, and have a nice time and happy investing. Thank you so much.